Hi, everybody. This is Andy Christopher with Leading Edge Financial. Hope everybody had a great holiday weekend, 4th of July weekend, and was able to enjoy time with friends and family. Well, welcome to our quarterly market update. This is something we're sort of kicking off as a newer initiative, really just to provide a backdrop and understanding of what's happening in the market, specifically the previous quarter. So right now we're looking at the second quarter of 2024, really April, May, and June. And so I think if we maybe let's take a step back and think about, why do we as investors even care about a quarterly market update? Why is that important to us? Certainly, almost all of our clients are long-term investors. And so a quarter market movement is probably not or should not rise to the level of changing your investing game plan. If it does, if what you hear, what you see in the markets causes you to think that maybe it's time to make some changes, definitely encourage you to reach out to your lead advisor. You can reach out directly to me, and happy to have that conversation. But I think the real reason we do a quarterly market update is just one, if you're interested in the markets, like we are here at Leading Edge, it's an opportunity to really just take stock of what happened, gain a better appreciation of what are the forces that are moving markets today. And that just makes us better informed investors, just given how important our finances and investing in particular are to achieving our long-term retirement planning goal. So that's our objective today. Is we're going to take a high-level look at what happened in the markets. Not meant to be looking at all the closets, if you will. There's some themes that I think are maybe resonate mostly with investors. We'll focus a little bit there. And our goal here is to be about 10 to 15 minutes. Hopefully you stick with me throughout the entire recording today. And again, we're always happy to have your feedback as we go forward. So with that, why don't we jump in? Let's just take a look at where we're at in the markets. So I think most importantly, as we look at what happened this last quarter, the U.S. stock market. So here locally is 3.22%. If we dive a little bit deeper into that, we may find is it's kind of what I'll call a tale of two markets here. In other words, some of those top 10 stocks in the U.S. market, Magnificent Seven, maybe you've heard that term, really driving the market over the last quarter and frankly the last year. Our international developed, so think countries like the UK, France, Germany, Japan actually had negative returns last quarter. Emerging markets, which has been a little bit of a sore spot in the markets, had a great quarter, up 5%. So those are countries like India, South Africa, Turkey. Those are actually some of the stronger performers in the last quarter. And then global real estate, it's taken a little bit of a beating. I think we're all familiar with what's happening in the real estate market kind of post-pandemic. That doesn't mean that real estate is exclusively, right? Office buildings, there's quite a bit that make up a real estate portfolio, but certainly that's being impacted as well. As we go to the other side of the spectrum here, look at our U.S. bond market, slightly positive for the year, not quite in line with our long-term quarterly averages, 0.9%, and then the global bond market, again, slightly positive. So it means yields generally came down, bond yields go down, prices go up. And so that's kind of right in line with our average. So that's a high-level snapshot. I think it's always important to just take a look at, what does this mean from a long-term perspective in the markets? And you can see our U.S. stock market, again, up on a trailing 12 months or trailing 1-year period, 23%. Think of the long-term average of the market, 10% annualized, so on an annual basis. And so that's quite a bit of bit performance. 14% over 5 years, 12.15%. So it's been a good 10 years in the U.S. Market. Keep in mind, this includes some not so good years, right? Our 2022, we had our 2020 blip and it ended up being positive. But certainly been a strong 10 years. The international developed market was negative for this quarter, doing okay over the last 1 year. Certainly, 4%. When we look over the emerging markets, despite a 5% return this quarter at 2.7 over a 10-year period. And so we've seen a persistence, not just this quarter, but historically, at least over the last 10 years, where U.S. markets have done exceedingly well compared to the international. We'll talk a little bit more about maybe some mindset to apply to that. And global real estate, again, not a great quarter, down over 1%, but 2.9 on an annualized basis. Take a look here, long-term U.S. bond market, again, trailing 1 year is 2.63. The big ouch here is, I'm sorry to cut you off there, 0.23% to the negative over annualized rates. So it's every year experiencing a negative return over 5 years. We saw as inflation picked up, the Federal Reserve rapidly raising rates in 2022. And it was not a fun ride for bond investors, and I think challenged the probably incorrect assumption. If you look historically what that stock to bond correlation is, but really challenged that, I think, long held assumption that, hey, when stocks go down in value, bonds go up and vice versa, and those two act as natural hedges. And so it's been a challenging long-term period for bond investors. Keep in mind, that's a nominal return. So if when you add inflation on top of that, that really starts to look bad from a real return perspective. I think we've made it through the worst, and we'll look at this in a little bit more detail. That's our long-term. Really, what we care about is long-term. If you're inside some of these timeframes, then it's probably time to think about what is the appropriate allocation. We think about the S&P 500 returning right around 14% this year. Hard to say what that means on a go-forward basis for the remainder of the year. I would say it wouldn't be unheard of to continue. You can see that's not an anomaly and anomalous historically since at least 1980, which is what this graphic depicts. Although you can see it's also not anomalous to have negative returns even in positive return years. You see we've already had a negative 5% return, and so I think we're just in that. We've had a good run, especially in the S&P 500. Again, that large cap segment of our market. It remains to be seen what holds for the remainder of the year. Certainly, interest rate components with the Federal Reserve probably have an impact on that, and just the economy and how the economy performs in general. Looking a little bit more granular, we'll look at the U.S. stocks over the last quarter, and this is again where we really start to see, I'd say, the tale of two markets. So the small cap segment having negative returns, value having negative returns, really the growth in the market driven by the large cap segment, and in particular that large cap growth. And so we've probably heard these names, the Magnificent Seven, right? So I think that's our Apple, Amazon, Google, Microsoft, NVIDIA, Tesla, Meta. So these big names that have really driven the market, and that they're not the top 10. That's a kind of a different sort of discussion, but they sort of play hand in hand. You've heard a lot of discussion on the top 10 stocks in the U.S. market really being concentrated, driving those returns, and in particular that Magnificent Seven being a part of that. And so again, if you were an investor last quarter just in U.S. equities, you had a 3.22%. That's nothing to scoff at. That's slightly above average, frankly, for long-term quarterly returns. And so I think investors can maybe take two divergent paths at this point when they evaluate at least the U.S. equity market. One is, hey, are we in a bubble, right? Are we in this overly concentrated valuation paradigm where this is going to pop and go bad? I think the other end of the spectrum is, hey, look at all these companies that are doing great. Let's pile in. So maybe let's break down both of those, valid concerns just right off the bat. And so this is the .com bubble right here. This is the 2000s. You can see trading at well over 40 time earnings. This green line these are our top 10s. And you can see those top 10s are right around 30 times earnings. So still, not an insignificant number, but certainly represent far less valuation, high valuations relative to where we were. And we did have that bubble, that .com bust. We had names like Pets.com, right? If you remember that. The other thing to take away is these top 10 companies. These are solid companies. They have solid earnings, right? I think we all understand that Apple, plenty of Apple products in my house, I'm sure, same for you. Apple is a solid company, good profits. Microsoft makes money. Amazon, right? If you don't have an Apple product, you have an Amazon box, shows up at your house, at least weekly, maybe more again in my household. So these are solid companies. You can see here they represent about 26% of the earnings in the S&P 500. It's nothing new. If we look in the upper right to see the top 10 companies in the S&P 500 really taking an outsized role in that index. We do find ourselves a little bit higher than the long-term average, where we have been historically at 37%. And I think the takeaway here is, is this a bubble? Will this pop? Of course, nobody knows. But I think this does point to diversification. Probably you don't want to be just in an S&P 500 index where 37% of your now equity holdings are going to be in just 10 companies. And so pivoting into this international small cap, some of the things that frankly haven't done as well over the last 10 years. And not to say that means they will do well, but certainly there's always a mean reversion component to stock market returns. I think the other end of the spectrum is let's pile in. And so these are every decade, the top 10 companies. So in 1930, it was AT&T, had a good run until the 70s, and now it's sort of fallen off. IBM in the 70s and 80s, Exxon in the 90s kind of popped back up in the 2010s. Microsoft's done really great over the last 10 years. We see Apple in 2020, at least. Of course, these numbers are changing. NVIDIA, I think, is at the top of the list here, kind of fighting between it and Microsoft here currently in 2024. But these numbers are always, these top 10 companies are always changing. Despite that, you didn't have to pick the top 10 to have a successful investing experience if you were invested in U.S. equities. So despite that, you can see investors have had quite a bit of success just being invested in the index. This is a natural progression as new industries, new technologies emerge. Quite frankly, creative destruction starts to maybe take out some of these incumbents as the markets progress. And, you saw in the newsletter we looked at, hey, what if you had invested in the top 10? What was your returns opinion? You probably would have kept in pace or kept in line with the equity market in general, and maybe slightly underperformed. And so again, this just goes back to diversification is paramount. Not trying to pick the winners or ride the winners, right, as we go forward. The last piece we'll say is that Magnificent Seven. This is really the same story from the top 10. 33%, this is year to date in 2024 versus the overall S&P 500, right, was right at about 14%. And then you can see just right, I think that's 5%, X Magnificent. Again, they're driving the returns. This is really nothing new, albeit we see ourselves in sort of at a higher percentage than maybe we've seen in the past, but certainly nothing new. Again, I think it's just a diversification importance there. For those concerned about investing, right, at we'll call all-time highs, plenty of data out there to suggest that that the market continues to be at all-time highs, and will frankly always continue to be all-time highs, probably albeit with some dips in between. So you can see here on the right, if you invested only at new highs, you only put money in at new highs, you actually have an annualized 5-year period had higher returns the investor that was invested on any given day, right? So put money on any day, right? And that's pretty persistent over some of the longer time periods. And so I think you never know the future of the market. I think a lot of us, certainly at Leading Edge, we say, when's a good time to invest? Well, it's now, right? Because again, we always have a positive expected return on the market. We don't have the crystal ball to tell us when that next downturn is going to happen. Shifting over to the international, right? We talked about developed and emerging markets, frankly lagging, despite the fact that emerging markets did quite well this quarter. On the left side here, these are the top 50 performing companies globally, including the US. You can see over half, so on average 33 of those companies are actually outside of the United States. Currently, we have just about 40 companies, right? 40 of the top companies in the world are outside of US borders. This gray here is developed, and then the emerging markets in the light blue. And so again, not to beat a dead horse here, diversification, being outside the US borders, right? There's still good companies that are frankly good at making money as we go forward in the equity side of the market. Let's jump into fixed income, and we'll round it out here. Again, slightly positive for the quarter. For the U.S. investors, you've had a pretty rough time. We've seen why, right, with inflation, and then as a result, the Federal Reserve raising interest rates in that impacting the fixed income segment of the market. Of course, I think what everyone's looking at for yields going forward and fixed income performance in general is just where is inflation going? We saw this was the painful, right, the 9% on the headline, which includes the food and energy, slightly lower on the core. We're getting down, right? This last reading here was 3.4%. The Federal Reserve target, right, is right at 2%, so still some work to do. But certainly inflation is starting to come down. I think we all, as we look at the minutes from Federal Reserves, they're trying to evaluate is just, is this persistently declining? Is it flattening out from this curve? And now can we start to make decisions about cutting interest rates so that we don't drive the U.S. into a recession? And can we get that, quote, soft landing from the, from an economy perspective? I think everyone is anticipating rates to trend down. We've been surprised before, but rates to trend down over the next year. Certainly the FOMC, that's who sets the rates at the end of 2024, predicting right about 5.1%. Market predicting rates to come down. FOMC has a long-term projection of 2.8%. And so we've had a pretty rough run on the bond market. And as we think about going forward, the number one predictor of your fixed income returns is the current yield, right? Is the current yield, which is what is depicted here in the blue diamond. across all segments of the fixed income market. So currently it's using US Treasuries. You can see the gray, this is the 10-year span, the average or the median, I should say, in this purple here. And again, across all segments, the current yield is really at the high end of the 10-year, and not making any predictions about the future performance of the fixed income markets. But historically, this is a good predictor of what your returns are. And so what your returns will be going forward as a fixed income investor. And so I'd say now's the time to pile in. But I think we can maybe take a little bit of solace in the fact that I think this is not the worst place to be as a fixed income investor. And certainly as rates come down, or as we anticipate rates coming down in the future, that should have a tailwind effect for a fixed income investor as well. Last thing we'll look at is just the federal finances. Wrote a little bit about this. We actually saw yields go up in the Treasury market. I think most importantly, what's driving that dynamic is the expectation of higher for longer on interest rates. But also keep in mind that the Treasuries are subject to the same supply and demand constraints as any other asset out there that you can go buy. And so, right here is our total 2024 budget. The sources of revenue, we essentially have a $1.9 trillion shortfall that is not coming from taxes and other facets. Part of that is 800 billion of interest, right, being impacted by higher interest rates. And so the Treasury has to make up the other part of that. So you can see our debt as a percentage of our GDP is continuing to go up. Started in the global financial crisis, again, 2020, COVID. And so that continues, I think, to be a concern for investors. And we saw at recent auctions, which is just when the Federal Reserve, using the Treasury, prices their bonds that they issue. They've had to issue at higher yields, right, to entice investors. Is this a red flag? I don't think so, right? The U.S. dollar is still the number one reserve currency. There's plenty of net buyers out there, and certainly at least at present, the performance of the U.S. dollar relative to, say, the Japanese yen has made it appealing to own these treasuries at higher yields relative to where they could get even in the international, in their own local currency. But it is something that's certainly on the minds of investors and is starting to show a little bit in the treasury market. So more food for thought, interesting than a red flag call out. So I think the major takeaways we think about what happened in this quarter. We've continued to have a good quarter. Diversification in the equity side, it's really being driven by some of those top 10. We can look across all spectrums here. And then on the fixed income side, really it's current yields being a good predictor of future performance, with the expectation that rates will maybe start to come down this year, that it may look to be a very appealing place to be a fixed income investor. Well, I hope you enjoyed our quarterly market update. Again, our goal every quarter is to provide you with a snippet of where we are at in the markets, whether that be in the newsletter or in this video. Again, please reach out to a lead advisor, myself, Andrew at Leading Edge Planning, if you want to have a discussion or any questions about what you heard today. Certainly happy to dive into any detail that you find interesting. Thanks again, and we'll talk soon.